What's up, everyone? We have some historic things to go over from the markets movement today. The VXX ETF is running up like crazy, and here's the interesting thing about it. It should not even be running up the way it is. So over the past 2 days, the VXX ETF ran up about 60%, and today alone it ran as high as 40% to the upside. But here's the weird thing. It should not even be running the way it is, and it's kind of like a fluke, or it's a very historic event. Now, if we look at this news on Reuters, we can see that Barclays suspends the sale of two products linked to oil and volatility. The volatility one is VXX. And if we scroll down, we can see that Barclays said on Monday that it has suspended the sale and issuance of two exchange-traded notes with combined assets of $1 billion, one linked to crude oil and one linked to market volatility, due to capacity constraints and a move that some investors said could spur big price swings in products. So basically what happened in English is Barclays said, hey, you know what? We're going to halt our sales and issuances on VXX shares. But here's the thing. Looking at VXX's long-term chart, clearly this thing falls very consistently and quite a bit. We could just see from March 2020 all the way to its lows just a couple of weeks ago, it went from $315 all the way down to $17.30. And this is kind of expected, and it's just how the ETN works. We can also see it just has like a very steady and consistent history of falling. Even if we look at an ETF similar to VXX, UVXY, this thing just falls and falls and falls and falls. Like, it's just very consistent, and that's how it's designed to be. And part of the reason it falls like this is, of course, because the market goes up and factors unrelated to today's video. But another part is because they constantly issue shares and they're selling VXX. And because of this, hedge funds say, you know what? If this always falls, why don't we short this ETF or ETN? And that's exactly what they do. So if we go back to the Reuters article and we scroll all the way to the bottom, we can see, so for VXX, a heavily shorted instrument with about 90% of its shares sold short, the halt of share creation makes it a prime candidate for a potential short squeeze, according to S3 Partners. So clearly there is quite the short, I guess you could just say short attack on VXX, and it's pretty common. But long story short, there's a bunch of people short VXX, and when Barclays said, you know what, we're going to halt our share creation and share sales of this, the shorts got squeezed in a just mind-blowing way. So we can see that over the past couple days, VXX went from $25 all the way up to $41.65. But here's where it gets interesting. So VXX fundamentally moves, like its movement is ultimately driven off of volatile or VIX index futures. It's kind of a tongue twister. So VIX index futures. We can see over the past 2 days, like they went up a little bit, but not really. Like from the lows of yesterday to the highs of today in pre-market, like yes, they went up a little bit, but it's even down today. So VIX index futures are what ultimately drive the price of the VXX ETF. And since they are falling today, they're down 3%, but VXX is up 18%. You're probably like, why is this happening? And this almost never happens, and this is why it's such a historic event, because VXX should not be as high as it is right now. The only reason it's like this is because of the news we had from Barclays saying, hey, we're actually halting our share creation and share sales. So basically what happened is all of these giant hedge funds, institutions, and whales in the market got screwed over today and caused the stock price to go up. This happened because, if you think about it, if 90% of the total VXX shares are sold short, okay, and then Barclays says, we're halting our share creation, that's going to make them want to buy back their shares to protect themselves. On top of that, the market has been crazy as it is. So we had some funds initially buying back their short position. And then on top of that, we had, it triggered more shorts to buy back their position because they saw the stock was rising in a crazy way, and they say, hey, we got to cover ourselves. And then on top of that, we have retail traders saying, wow, VXX is up 10% today. Maybe I'll buy some shares. And then we have other traders saying, you know what? It actually looks like a good setup. It's breaking out. I'm going to buy some shares. And on top of which drives the price higher. And then you see a lot of traders out there saying, you know what? VXX went from 26 up to 30. What's stopping it from going from 30 to 40, which is exactly what happened. So some traders, actually quite a few traders, bought VXX call options, and some of them did very, very well. We can see over the past 2 days, the VXX 30 strike call for March 18th went from $27 up to $1,200 over the course of basically less than 24 hours, which is mind-blowing. But basically, we had people buying call options, buying shares. You had an existing very large short float on the ETF. So basically, shorts are put in a terrible position. And then on top of that, when they're in this terrible position, the only way for them to really protect themselves is either buy back their VXX share position or buy VXX calls. And if they bought VXX shares, it drives the price higher, which is exactly what we saw. And if we saw anyone buy VXX calls, whether it was you, me, a hedge fund, anyone, basically you have to think about, where do those calls come from? Like, they don't just appear magically and you now own the call. And it goes the same for put options too. But market makers are the ones who create the call options. That's like what happens in a very large majority of the time, because writing naked call options is pretty complex and it requires a decent amount of margin, but that's a topic for another video. But anyways, when you buy a call option, someone is selling that to you. And let's say you were to go to VXX right now and you said, you know what, it's at $33.60. I think there's a decent chance it can be greater than $38 by, let's say, April 14th. So what did I say, the $38 level? So you might go to the 38 strike call for April 14th, and you can buy that for around $600. So you paid someone for $600, but the same person who sold you that 38 strike call essentially has a short position on VXX. Think about it. If they are selling to open the 38 strike call, that means that they will have to short 100 shares of VXX at $38 each. So what happens, especially when we have a buying frenzy of short-term call options, you have a bunch of people buying all these call options, and then you have the stock rising in a crazy way. This is what's called a gamma squeeze. So the people who shorted those naked call options, they have to buy shares of VXX in order to hedge themselves, because if they don't, they will be set up for just an absolute disaster, because they might short call options at like $35, and then the stock might go up to $45, and they just get demolished. So this is a crazy situation, and it is extremely rare to see what we saw today with the VXX. It's crazy to just see this type of movement. Of course, yes, we have volatility. Like, it'd be different if the market was down 20% today or something bizarre like that, but the market's up 1.5%, and VXX is up 16%. That is like almost unheard of. Even if we look at some comparable ETFs or ETNs to VXX, UVXY is down almost 3%. The VIX index is down 2%. And then VIX index futures, which is exactly what drives the movement of the VXX ETN, is also down 3%. So VXX should be down today, but instead it's up a crazy amount because of the reasons I listed. So it's such a historic event, and I definitely wanted to make a video about it. Just for a quick recap, short squeeze, there was a giant short squeeze that happened. A lot of hedge funds got screwed over because there was such a giant short float. We saw a gamma squeeze most likely. And then, of course, I guess you can say people buying the breakout and all that stuff just made the situation that much more explosive. So it was a crazy day in the market today. Looking at the S&P 500, it's not bad. We are up around 1.5%. So keep an eye on VXX. Now, I will say this. Be extremely, extremely, extremely careful with it right now for two reasons. If you're looking at it for like a potential share play, please understand that VXX is overvalued right now. Does that mean that it will go up tomorrow? No one knows. Like, for example, if the market crashes tomorrow, then yeah, VXX will probably rise. But I would say it's not a smart idea to be buying VXX right now because it is much higher than it should be trading. If we go back to the Reuters article really quickly, we could see right here, typically large banks buy and sell shares to generally keep the trading price of the ETNs in line with their indicative value. But the suspension of new shares that process can break. So basically what's happening is what we're seeing with Barclays suspending the creation and sales of new shares. It's making the market do irrational things. And while it's like, I guess you can say surprising in the short term, over the long term, it will even itself out. So VXX is overvalued right now. Does that mean it can go up higher? Sure. Does that mean it can fall tomorrow? Sure. No one knows what's going to happen tomorrow, but I am saying right now it is overvalued relative to what we are seeing across the other volatility products and the market overall. So proceed with caution if you're going to play VXX. And then if you're looking at options on VXX, this is like even more risky because the security itself, VXX, is overvalued as it is, but then the options on this thing are mind-blowing. Like the implied volatility is 170%, where just a couple months ago it was at like 100%, maybe 80%. So the options you're buying are extremely overpriced, and I think whether you're looking at it for calls or puts, it's just a bad idea. What I do think can be a good idea with VXX is short volatility strategies, but you have to be very careful because we are seeing crazy things in the market. So, maybe look at some things like call credit spreads, maybe put credit spreads, maybe iron condors. In my opinion, those three types of spreads / strategies would be ideal because of the increased volatility that is anticipated on VXX. And it just puts the odds more in your favor because you get to kind of take advantage of those overpriced options. So I hope you guys learned something from this video. I know it was probably confusing, so if you have to rewatch it, feel free. If you liked today's video, please consider subscribing. I post brand new videos every single day, and we have some awesome new things that we have in store for the channel. So if you guys like today's video, please consider subscribing. Comments help me so much, so if you want to leave a comment, I'd greatly appreciate it. Besides that, thank you guys so much for watching.